Today, the market's gripped by extreme fear, a chilling 9 on the Fear and Greed Index, with Trump policy risk at level 3. Welcome to Denver Stock Lab, where we bring in engineers' precision to tech stock analysis. I'm your host, and this morning we're dissecting the pre-market action for SMH, SOXL, and BOTZ. Let's dive into the data. Trade tensions and tariff uncertainty are driving the VanEck Semiconductor ETF, a technology category fund, down 1.73% to $374.25. With a significant year-to-date gain of 1,276.8%, this ETF's performance is closely tied to the sector's trends. As stocks stumble due to global trade uncertainty, what's next for this fund, and will it continue to ride the wave of growing demand for artificial intelligence and 5G technologies? Alright Denver Stock Lab fam, let's dive into the SMH's fundamentals. While the AUM isn't readily available, remember fund size impacts liquidity. Bigger funds often mean easier buying and selling. We're also missing the expense ratio, but typically, tech ETFs can range. Now, for performance, a staggering plus 1,276.8% YTD and a 3-year average of plus 44.5% tells us this fund is absolutely crushing it. Looking at top holdings like Nvidia and TSMC, it's clear SMH is heavily weighted towards the titans driving the semiconductor revolution, giving you direct exposure to their growth, but also their specific market risks. Alright, Denver Stock Lab fam, let's dive into SMH's technical setup. The RSI at 38.0 is sitting in neutral territory, suggesting no extreme overbought or oversold conditions, so the fund remains technically balanced. Currently, the price is right at both its 20 and 50-day moving averages at $374.25, indicating a short-term bearish trend. Keep a close eye on support at $355.54 and resistance at $392.96. Momentum is fading, and we'd need a decisive break above resistance to confirm any trend continuation. The main macro force driving SMH is trade policy, with the US-China trade tensions posing a significant risk. The AI score of 45 implies a neutral near-term direction. A key catalyst to watch is the US policy on tariffs and Fed rates. Retail investors should monitor the trade war developments and consider a cautious approach to SMH given the uncertain outlook, focusing on long-term growth trends in AI and 5G technologies. Trade tensions and tariff uncertainty are driving the Direxion Semi-Bull 3X ETF, or SOXL, down 4.82% to $46.61, a trading leveraged equity play. With a year-to-date gain of nearly 4,940.8%, this fund's volatility is on full display. As stock markets stumble amidst Trump tariff uncertainty, investors are bracing for potential impact on the semiconductor sector, and we'll be watching to see how SOXL navigates this uncertain landscape going forward. For the Direxion Semi-Bull 3X ETF, we're missing specific AUM and expense ratio details, but typically, larger funds offer better liquidity. This fund's YTD return of nearly 4,940% is staggering, and its 3-year average of 43.8% suggests strong performance. The top holdings, however, show zero allocation to major semiconductor players like MU, MAT, NVDA, and AMD, which is unusual and may indicate a different risk profile than expected. The RSI reading of 40.4 indicates a neutral position, suggesting no extreme overbought or oversold conditions. The price is currently aligned with both the MA20 and MA50 at $46.61. Key support is at $44.28. While resistance sits at $48.94. Momentum is fading, and a break below $44.28 could confirm a trend continuation downward, while a push above $48.94 would suggest a reversal. The main macro force driving SOXL is trade policy uncertainty, as seen in the Trump tariff headlines. The AI score of 42 implies a neutral near-term direction. Watch for the upcoming launch of new semiconductor products as a potential upside catalyst. Given this, retail investors should consider a cautious approach, waiting for a clearer trend before investing in SOXL.
Denver Stock Lab.
Tariffs and regulatory uncertainty are driving the Global X Robotics and AI ETF, or BOTZ, down 2.49% to $32.46, a miscellaneous sector fund. With a year-to-date gain of nearly 798%, this ETF's significant growth is notable. As trade war fears resurface, with stock markets stumbling over Trump tariff uncertainty, investors are eyeing BOTZ's next move, wondering if this downturn is a buying opportunity. For the Global X Robotics and AI ETF, fund size and liquidity are concerns with an unknown AUM. The expense ratio is also unspecified, making it difficult to assess its cost relative to its category. Despite this, the fund's YTD return of nearly 798% and 3-year average of 10.2% are impressive. Top holdings include ABBN.SW, NVIDIA, and 6954.T, indicating a focus on robotics and AI, but the 0% allocation suggests a potential data issue, making it hard to gauge actual risk exposure. Alright Denver Stock Lab fam, let's dive into BOTZ's technical setup. That RSI is flashing 26.2, screaming oversold conditions, which could signal a potential mean reversion entry for swing traders. Price is sitting right on both its MA20 and MA50 at $32.46, indicating a bearish short-term trend. Keep a close eye on support at $30.84 and resistance at $34.08. Momentum is fading here. A break above resistance would confirm a bullish trend continuation. The main macro force driving BOTZ is trade policy, with tariffs on Chinese imports affecting robotics components. The AI score of 48 signals caution. A key catalyst to watch is the U.S. policy on tariffs. With the RSI at 26.2, a mean reversion bounce may occur. Retail investors should consider a potential buying opportunity on further dips, given the oversold conditions and positive long-term outlook. Alright, Denver Stock Lab fam, let's dive into what's pummeling ProShares UltraPro QQQ, ticker TQQQ, today. This leveraged equity ETF is down a brutal 5.94%, trading at $38.78. That's just a tiny slice of its absolutely staggering minus 592.8% year-to-date performance, which is pretty wild. The headlines are screaming about renewed Trump tariff uncertainty, and that's definitely shaking up the tech sector TQQQ tracks. The big question is, can it find a floor, or is there more pain ahead? For TQQQ, the fund size and expense ratio are not available, but typically, larger funds offer better liquidity. The expense ratio is usually on the higher side for leveraged ETFs. With a minus 592.8% YTD return, this fund is underperforming, but its 3-year average return is 47%. The top holdings are surprisingly 0%, indicating the fund's actual holdings may not be accurately represented, potentially masking its true risk exposure. The RSI reading of 22.9 indicates oversold conditions, potentially setting up a mean reversion entry point. Price is currently aligned with both MA20 and MA50 at $38.78. Key support sits at $36.84, while resistance is at $40.72. Momentum is fading, but a break above $40.72 could confirm a trend continuation, while a drop below $36.84 would suggest further downside. The main macro force driving TQQQ is trade policy uncertainty, particularly the ongoing US-China trade tensions. The AI score of 48 signals caution, implying a potential near-term downturn. With the recent stock market stumble as global trade faces more Trump tariff uncertainty headline, investors should watch for upcoming earnings reports from top tech firms, and consider a mean reversion entry point given the oversold RSI, making TQQQ a potential buy for retail investors. Trade tensions and rate hikes are driving the Global X Cloud Computing ETF, a technology sector fund, down 3.49% to $18.80 today. As cloud ETFs shine despite market sell-off, this fund's year-to-date performance is notably weak, with a loss of 1,694.7%. With its diverse portfolio, can CLOU rebound from its current slump and capitalize on the growing demand for cloud-based services? The Global X Cloud Computing ETF has an unknown AUM, which raises concerns about liquidity. Its expense ratio is also unknown, making it difficult to assess its cost relative to peers. With a staggering minus 1,694.7% YTD return, this fund is severely underperforming. Top holdings include AKM, DOCN, and DLR, which are all allocated at 0%, indicating a potentially high-risk portfolio with unclear exposure. The RSI reading of 35.0 indicates a neutral positioning for CLOU. The price is aligned with both the MA20 and MA50 at $18.80, showing no clear trend advantage. Key support is at $17.86, while resistance is at $19.74. Momentum is currently fading, and a break below $17.86 would confirm a trend continuation downward, while a move above $19.74 could signal a reversal. The main macro force driving CLOU is the ongoing US-China trade tensions, with headlines like "Stock markets stumble as global trade faces more Trump tariff uncertainty fueling uncertainty." The AI score of 39 out of 100 implies a bearish near-term direction. Watch for the Fed's next rate hike decision, which could impact borrowing costs for cloud companies. Investors should consider a cautious approach to CLOU, potentially waiting for a clearer trade policy outlook before buying. Today's top signal was BOTZ holding strong. If you found this analysis helpful, please subscribe, like, and comment below which stock you'd like us to cover next. Remember, this is educational content only, not financial advice, so do your own research and consider that past performance doesn't guarantee future results. Thanks for watching Denver Stock Lab. We appreciate your support.